All right, let's just jump right in. Welcome to this explainer where we're going to take a really close look at an absolutely vital step in your real estate journey. Look, we all love scrolling through property listings, right? Imagining our lives in a beautiful new space somewhere in South Carolina. But before you even think about attending an open house or calling a realtor, there is one absolute, non-negotiable step you have to take. You need to map out your budget with a South Carolina-specific mortgage calculator. And today, we're going to break down exactly why this tool is your ultimate secret weapon for a totally stress-free home purchase. So, let me ask you a tough question. Is your South Carolina dream home actually in your budget? I mean, it is incredibly easy to look at the list price of a house, divide it by 30 years, and think, hey, I can easily afford that, right? But let's be real, that sticker price is just the tip of the iceberg. Buying a home is a massive financial milestone, and honestly, so many buyers get caught completely off guard because they forget about those hidden monthly costs that absolutely wreck their actual budget.
Because here's the reality check. Your monthly mortgage payment isn't just paying back the money you borrowed, the principal, plus the interest. You are also on the hook for property taxes, homeowners insurance, and potentially private mortgage insurance, or PMI. Oh, and don't forget HOA fees if your new neighborhood has them. A generic calculator just won't factor in local rates accurately, which is exactly why a South Carolina-specific calculator is absolutely crucial to avoid a nasty case of sudden sticker shock.
To get you fully prepared, here's our roadmap for today's explainer. 1. The hidden costs of buying. 2. Why you need a calculator. 3. Exploring your loan options. 4. Calculating the down payment. 5. Navigating local taxes. And finally, 6. Planning your financial future. Okay, moving into Section 1, the hidden costs of buying. This is looking beyond that initial list price. Let's talk about a massive detail regarding how South Carolina handles property taxes. Unlike some states, your tax rate here drastically depends on how you actually use the property. If it's your primary home, it's taxed at an assessment rate of 4%. But if it's a second home or an investment property, you're looking at 6%. Now, I know a 2% difference might sound kind of small, but trust me, it will significantly shift your monthly budget. And if you're just using a generic national calculator, it will almost certainly miss the state-specific nuance. Which brings us to Section 2, why you need a calculator. It's time to bridge the gap between expectations and reality. So the crucial point here is knowing exactly how to feed this tool the right data. It's basically a simple three-step process. First, you just enter the total home value. Second, input your down payment percentage and your expected interest rate. And third, and this is the most important part, you add the local property taxes and homeownerships. By empowering yourself to run these specific numbers, you aren't just flying blind anymore. You get a realistic, actionable output that shows you exactly how much cash is actually leaving your bank account every single month. Now for Section 3, exploring your loan options. Let's find the right fit for you. You see, South Carolina offers a variety of financing paths, and a really good calculator lets you toggle between all of them. You've got conventional loans, which usually need a strong credit score and anywhere from 3 to 20% down. Then there are FHA loans, which are backed by the government, requiring just 3.5% down, super helpful if your credit is a bit more flexible. Now, if you're military, VA loans are absolutely incredible, often requiring 0% down and 0 private mortgage insurance. And finally, USDA loans offer 0% down for specific rural properties. Each one of these completely changes your monthly math. And beyond just the loan type, you also have to choose between a fixed rate and an adjustable rate mortgage, or ARM. Fixed rate loans, they give you rock-solid predictability. Your principal and interest payment won't budge for 30 years, which is just perfect for long-term owners. On the flip side, adjustable rate loans often start with a lower initial rate, but they can and will fluctuate with the market later on. So if you know for sure you are only living in South Carolina for a few years, an ARM might actually save you money up front. A great calculator lets you model both scenarios to really see the long-term affordability. All right, Section 4, calculating the down payment. This is literally the foundation of your mortgage. Think about the real monthly impact of putting 5, 10, or 20% down. Obviously, a larger down payment simply means you borrow less, which naturally shrinks your monthly payment. But here's the real magic trick. Hitting that 20% down payment mark completely eliminates private mortgage insurance, or PMI. And look, PMI is just a fee lenders charge to protect themselves if you default. It offers you literally zero financial benefit. By playing around with a local calculator, you can see exactly how much PMI is eating into your monthly budget, and you can figure out whether it's worth waiting just a bit longer to save up for that full 20%. Section 5. Navigating local taxes. we really need to drill down into these hyper-local costs.
0.45%. That number right there is South Carolina's effective property tax rate. It actually ranks as the 6th lowest in the entire United States. I mean, that is a massive perk of buying a home in the Palmetto State. But even though it's remarkably low, it still has to be precisely budgeted for. And remember, that rate varies by county. Charleston County is going to be different from Greenville or Richland County. Fortunately, a top-tier local calculator will have these county estimates preloaded for you.
But you knew there was a catch, right? While those taxes might be wonderfully low, if you're eyeing a property along the beautiful South Carolina coast, you have got to account for elevated insurance premiums. Coastal homes face very real, significant wind and hail risks. You absolutely cannot just use a national average for home insurance here. It will drastically undercalculate your monthly obligation. You have to plug real, local insurance quotes into your calculator to get an accurate picture of your true costs.
Wrapping up with Section 6, Planning Your Financial Future. Let's get you prepared for closing day.
$2,883. This is the average South Carolina closing cost. Now, while this is actually a bit lower than the national average, it is still nearly $3,000 of upfront cash you must have saved up, and that is on top of your down payment. A solid mortgage affordability calculator is going to help you factor this one-time expense into your total buying power so you aren't scrambling at the last minute.
So what exactly is that $2,883 paying for? Well, these closing fees cover things like title insurance, deed recording fees, pre-funding your escrow accounts for those taxes and insurance we talked about, and, of course, your professional home inspection. But here is something you absolutely need to know. South Carolina uniquely requires an attorney to be present at closing. You can't just use a title company like you can in some other states. That attorney fee is a mandatory upfront financial requirement that has to be factored into your budget.
I know, navigating all of this can feel a bit overwhelming, but there are some genuinely smart, state-specific strategies to help you out. For starters, consider parking your down payment fund in a high-yield savings account to grow it a little faster. Also, definitely look into SC housing programs like the Palmetto Home Advantage. They offer actual down payment assistance to first-time and move-up buyers. And hey, don't hesitate to reach out to HUD-approved housing counselors in South Carolina. They can help you optimize your finances well before you ever apply for a loan. I really want to leave you with this fantastic quote from our sources. The best time to plan for your financial future is before you commit to a long-term mortgage agreement. I mean, that perfectly captures the core takeaway of this entire explainer, doesn't it? Early, proactive planning using a localized calculator isn't just about doing the math, it's about gaining financial peace of mind. It allows you to shop with total confidence, knowing exactly what you can afford without ever becoming house poor. So I'll leave you with this final thought to chew on. If interest rates unexpectedly shifted tomorrow, would you still be able to afford the home you're looking at today? Don't just guess the answer. Get a South Carolina mortgage calculator, run your numbers, play around with the rates, and test your own financial resilience right now. Thank you so much for joining me on this explainer, and happy house hunting.